If you think about it in terms of at least what I do, I'm offering a non-correlated and sometimes negatively correlated return stream to people who are looking to put together a portfolio.
Yep.
So the idea is when most people are losing money, I should make a bunch of money. And when most people are making money, hopefully I don't lose too much, right? If they make 10 and I lose 10, and then they lose 10 and I make 10, that doesn't get anybody anywhere, right?
Yes.
They make 10 and I lose 2, and then they lose 10 and I make 10, now we're getting somewhere, right?
Yep.
And that's where sort of the 0 to slightly negative correlation comes in, right? So during that time period, trend following was crushing it. It was one of the greatest periods for trend following that we've seen in a while, in a few years, right? So I wasn't getting any trades, so I wasn't losing any money. So I was flat while they were killing it, right?
Yeah.
And then the last few months, we've had a really good run on my stuff while trend following has given back. So, that's why I think I'm able to a little bit, and I'm not perfect at this, believe me, okay? But I'm able to keep my discipline pretty well because I feel pretty confident that my process will create over time the return stream that I am telling my clients it will create, right?
Mm-hmm.
It's not necessarily about, and this is why I tell people you shouldn't necessarily copy trade me because my goals are maybe different than yours. Your goals are to maximize your P&L at all times, right? My goal is, yes, to maximize my P&L versus drawdown, but at the same time to do so in a way that has no correlation or negative correlation to other return streams, right? So that's a third sort of constraint on that, where you might not have that constraint, right? And the people that are sort of copy trading me or even putting my process to work in a slightly different way, I talk to them about how this should just be a piece of your portfolio. The true way to riches over time is having a portfolio of non-correlated return streams that have positive return expectations, right? Not having one thing, having a portfolio of these things, right? And this is one piece of that portfolio, right? Which is hard to get.
Right.
It's hard to find negative correlation with positive return expectations. And this does that, but I don't put all my money in this, and I would never take a client on that was putting all of their money in this. That's not the idea. My clients are diversified fund of hedge funds that have different return streams in there, and they give me whatever percentage that they think is going to push out the efficient frontier the best for them based on my returns. But anyway, that's kind of the point there. So it helps me with my discipline, knowing that that's what I'm supposed to be doing. That's my job, and my clients certainly didn't when I was flat, for 3 months there because they were crushing it,
Right.
Well, when I used to raise money and I would market to these people, I used to say to them, I had a marketing guy that would just cringe every time I did this. But I'd say to these people I'm raising money from, I go, here's what you want to happen. You want to give me money, and then you want me to lose money every single month. Because if I lose money every single month, it means everybody else in your portfolio is making money.
Yeah. Mm-hmm.
Now, that's never going to happen, right? Well, I don't know if it's never going to happen that I lose money every month, but it's never going to happen that all your people are making money every month, right? But just that's the point, right? I used to say it to them because I really wanted to attract capital that understand what they were getting into here. This is a whole nother conversation when you manage outside money and the nightmares of the clients that you can get in, that when it's a wrong client. It's just like, but it's very similar when you're trading. When you're trading something that's not you, it makes it that much harder, right? Mm-hmm. So when clients that were giving me money and not understanding what it is that I'm doing for them, it just makes it that much harder as a relationship. So I was really trying to attract the clients that understood and were getting into my stuff for what I consider to be the right reason.
Mm-hmm. And during and just very quickly, just during that time, though, all those assets and things that were trending really well in the first 3 months, were they crowded trades at that point, or they weren't crowded trades?
That's the beauty of it. I wasn't getting any trades because there was nothing crowded.
Yeah.
Right? And the fact, I will argue, that there was nothing crowded is why the trends were able to continue and why trend following was making so much money.
Yeah.
Right.
Mm-hmm.
And then once they get crowded, okay, now the trends can reverse. Right.
That's so interesting.
But not until then. That's how I can't prove that's true, but that's what I believe. And it certainly worked during that time. Right.
Yeah.
Mm-hmm. Yeah. No, that totally makes sense. That again, it's not until you kind of get to the extremes. And I mean, you can call it what you will. You might say, okay, is that kind of like mean reversion? Things get out of whack and then they come back, to the mean, whether it's on the upside or the downside. You know, one other part
mean
to
reversion of positioning rather than mean reversion of price.
Okay.
Oh, I like that.
So explain that a little bit. Yeah, that's
like
interesting.
I was saying before, I'm not shorting something just because the price has gone up a lot.
Yeah.
Right.
I'm shorting because people have gotten way long. So I'm not mean reverting price, but you could argue I'm mean reverting positioning. They get super long and then, okay, it starts to sell off. They get out. And once they're out, then I'm covering my short, right?
Yep.
So I'm sort of doing mean reversion of positioning rather than price. Mean reversion of positioning, just like a price, just like any price thing that you're fading, I think is extremely dangerous. I never got it. So this thing is 3 standard deviations away from its mean. So I'm going to short it. Okay. What happens when it goes to 4 standard deviations?
Right.
Well, then are you shorting more?
Yeah.
And what happens if it goes to 5 standard? Like that's how you blow out.
Yeah.
Yeah.
As
I've never understood that. I understand that over time, okay, things will mean revert, but it's the exact opposite of what I do. You'll make money mean reverting price more than you'll lose, more times than you'll lose money. But the times that you lose money, you will blow out.
Yeah.
So you won't be around, right? It's the exact opposite of what I do. A higher probability, but horrible payout over time is how I see mean reversion of price.
Mm-hmm. And especially for those kind of black swan events, that's where you get into a position where, you can no longer get more on one side because you just run out of money because you can only be wrong so many times.
And don't get me wrong, markets can turn without them being super crowded. Okay, things happen. Good news comes out, bad news comes out. Market goes up and down. I miss market turns in markets all the time, right? But it's not a question of me trying to get every single market turn. It's a question of me getting the trades that I do take being the market turns, right? So markets do things. This is just one thing that happens that I happen to catch, but markets do other things too that I don't play in. And you know what I mean? Cocoa went straight up and then came down. I didn't catch that turn. It wasn't crowded at the top. I didn't catch it. Okay, so what? There's plenty more. I trade 37 markets. They move up and down every day. You know what I mean? I have 3 positions on. That means there's 34 markets that I missed something in, right? But that's not the point, right? The point is what I am doing a specific thing, and I just want that specific thing to work when it, So
right. And one more thing on kind of the correlation side of things, because I feel like a lot of people will think that they're diversified and safe when they have a lot of different stocks, and I think that sometimes lulls them into some complacency because they don't realize that, there's kind of the correlation of crisis where when bad things happen, a lot of times, even if you have normally uncorrelated things, they kind of all correlate to one, either for good or for ill, right? In 99, a lot of things were correlating to one on the good side. In the 90s, 2008, a lot of things were correlating to, one on the negative side. But those correlations just get much, much higher. Do you find that your stuff does kind of keep, again, that correlation of crisis a little bit outside of that?
Yeah, look, my stuff by definition is not going to have correlation because I'm fading something that everybody is long. I'm shorting something and everyone's long. I'm longing something everyone's short. So again, when I was raised money, I used to say to people, look, I can't guarantee you I'm going to make you money. It's illegal, first of all. And second of all, it's disingenuous. But I can come pretty darn close to guarantee you I'm not going to be correlated to anything in your portfolio, right?
And we found that in the bear markets, right? Where all those stocks will go down, right? But they'll all.
Clearly, how did your diversified portfolio of stocks do in 2008?
Exactly.
Right.
Exactly.
Yeah.
It didn't help you one bit, and that's when it needs to help you. That tends to be the thing, right? When you need it most.
Yeah.
Is when it helps you the least, right?
Yep. And again, sometimes you get lulled into that complacency because when everything is going great, you don't think about you don't think about that downside. And also kind of on that diversification side, I think of a lot of times where, there was one point in time, where I was going out and speaking and someone was talking about, their portfolio, and, they gave me like, oh, here's a telecom company that I have. Here's a metals company that I have. Here's a tech company that I have, and a real estate company that I have. But they were all Chinese. I was like, that's not correlated. Something happens bad in the Chinese market, and they're all going down. And
if you're going to be honest about it, which gets to your point, Arisha, I think if you're sitting on this portfolio and the market's going up and all of your stocks are going up, then you're not diversified.
Right.
Yeah. If you're going to be honest about it.
It's so true. Right? You're absolutely right. Yeah.
You should say to yourself, something's wrong here. I mean, it's great. I'm making money, right? But the truth is, what happens when it goes down? If they're all going up while the market's going up, then there's a pretty damn good chance that they're all going to go down when the market goes down, right? Exactly. So that ain't diversified. Yep. Ride it if that's what you want to do, but don't tell me you're diversified, right?
Yeah. Understand what you've got. And, I think a lot of times, again, that complacency comes from the fact that, people kind of attribute that to their just great stock picking. Oh, I'm just good at this. That's why it's all going up, not that you've got correlated assets necessarily. So,
Bull markets, right? Everyone's a genius in a bull market. Absolutely.